That's where I took profit at, and that was a good level. It was a daily resistance or sell level, right? That was in fact a good place to take the profit. Why? Well, what did it do since then? It came back down basically, and then bounced back up halfway and came back down, and is now even lower than it was at the start of yesterday. So happy new week on the Bitcoin chart. Today, obviously, the markets, traditional markets, reopen in the U.S. So there will be a lot of people coming back to their desk after being away for a few days, because of the holiday. And remember, because of Memorial Day weekend, some people also took the day off on Friday. Officially the holiday was only yesterday, but many people take that Friday off so they can have a longer weekend. So some people are away for 4 days or so. But in any case, the markets have been closed for 3 days, effectively, traditional markets, and now Bitcoin's been basically moving sideways, right? Yes, it had that little move up and it had that little move down. And should not surprise anybody, especially if you know how the VEPs work. Right? If you were trading on low time frames, you would have seen all this happening very clearly, because that's exactly what happened. It happened very clearly. It's not some mystery of how or why. It's literally just a volatility, entropy, probability, and statistics. So, little big wins, big little wins. Rack and stack them, that's how you trade. And rinse, repeat. Don't try to make that one move that's going to win you your financial freedom or whatever. It's not going to happen in one move. Okay? You want to achieve the dream, you need to rack up a lot of little trades over time. That's how you do it. And you don't have to trade, 1, 2, 3 trades a minute. Even if you use the 1 minute time frame, in fact. I use the 1 minute time frame, and my typical trade lasts anywhere from 7 to 15 minutes. Right? And yes, you could trade the 1 minute time frame and be in and out in less than a minute. If you do that, you probably want to be looking at the 30-second and the 15-second time frames just to make sure that you know what's going on within that 1 minute, so that you don't make a mistake, right? Or so that you don't make avoidable mistakes at the very least. But if you don't have sub 1 minute access on your trading view account, then you still want to scalp low time frames. Well, 1 minute is perfectly fine for trading the 1 minute time frame, and most likely your trades will be longer than a minute long. You do not have to basically, you do not have to try to be a robot, right? The whole idea of having access to the same math that the robot have is not to try to be a robot, but it's to basically be able to ride on their coattails, know what they're doing in the lower and slightly higher time frames that are actually relevant to your scalping time frame, and then ride those coattails and grab those crumbs that they're leaving on the table. Instead of trying to trade against them, just go with their flow, right? If they're going sideways a lot, then you go sideways a lot. So shorter trades, faster trades. If they're going generally up, you go generally up. I'm talking about the volatility and the correlation showing you that, right? Or the entropy and its correlation showing you that, or divergence play, or whatever it might be. Something. Don't get fooled by the price action candles. The price action candles, remember, are nothing more than the product of what's happening with the volatility, or the entropy. That's it. I was watching, some information about Le Bitcoin, listening to some of the usual talking heads, and one of them was an interview with Michael Saylor,
and he was talking with Peter McCormack, if you know who he is. Peter has that podcast, What Bitcoin Did, whatever. Anyway, Michael was saying how volatility is a dirty word. And what he meant is in the investment community. Volatility is a dirty word, specifically among investors of specific companies. Like if you look at a CFO of Microsoft, right? They don't want volatility, right? They want predictability, stability. That's why, as he points out, if you ask the CFO of Microsoft what his earnings will be next year, he can tell you plus or minus within 1%. And that's because they have long-term contracts. Right? Their whole business is based off of selling enterprises 3-year contracts. So they know roughly what their business is going to be in next year. Right? Frankly, they know for the next few years, but solidly they know next year. Okay. So, with that being the case, that's how inside company men look at it. They want to know the predictability, right, of their earnings, etc., so that they can tell you their EPS next year. They can forecast all kinds of things. What he doesn't mention in that particular discussion, or what doesn't really go into, because he's not a trader, he's an investor, is that for people who are actually trying to accumulate an asset like Bitcoin and to understand its future potential and all that, volatility is actually your best friend. It's the thing that is most highly desired by the high frequency trading firms who trade it. And that's for very, very simple reasons. Right? Because the volatility is what gets the traders all of that juicy and delicious profit when they're on the right side of the trade. The volatility is how big returns are yielded, right? Because the volatility is literally the standard deviation of the returns. So when the returns are moving up or down, and you know which way they're going, and you make the trades based on that, and you make the trades correctly, the profitability of your actions is going to be much more significant in a much more rapid amount of time, and a much more condensed amount of time, than an investor who sits around and waits for the paint to dry in order to yield, whatever the nominal percent return is. Of course, there are different goals, right? The traditional investor is looking at their stack and saying, okay, what's the benchmark I want to beat? The benchmark I want to beat is the S&P, right? Okay. So if the benchmark you want to beat is the S&P, there's a number of options you can do. You need to manage it yourself, which most investors don't want to do. And you can hand it to a manager who then charges a fee. And by charging you that fee, they need to perform that much better in order to beat the S&P, even just to match the S&P, right? But if they just match it, there's no point in that because you could just as easily have purchased, in a mutual fund or through a broker or whatever, buy the S&P fund, and that's it. You do it yourself. Again, automatically, right, without the need of a manager. Yeah, but then you have to pay them 1 or 2% or whatever they charge. So it isn't just as simple as that, right? So there's all these fees involved. No matter how you slice it, if you're going to have other people or parties involved in running your trades, which means you're going to have to find a smart manager if you want a smart manager to actually be able to beat it for you consistently and to give you a return that's positive. And the way that that's done, either you find somebody who's really good at this, right, a smart money manager who can actually beat the market, right, because that's what the big investor with the big amount of money backing the company wants to know is, how can you give me a return on my money, right? That's better than the S&P. The other thing is you have to ask yourself, why is that the benchmark? Because over 100 years it's gone up on average 7 to 8%. It's had some down years, but if they have a guarantee of a few percent, pretty much, first of all, who can guarantee any percent, right? Really nobody. If they do, it's a scam. So consider that, right? Like, who is guaranteeing a percentage gain of any size on any market, on any asset, right? The only people that can really do that are governments who, let's say, print fiat, and they know how much fiat they're going to print, so they know how much they're going to devalue their fiat this year. That's it, right? That's why T-bills, bonds, credit, those things can be quote-unquote guaranteed to a certain extent, as long as the governments don't break their word, which of course they do all the time. So consider that, or as they say in the parlance of our time, put that in your pipe and smoke it. Okay, happy trading. Bye.